Hello and welcome to Online Trading Academy's Quick Look. My name is Merlin Rothfeld. We've got a very busy economic calendar and earnings calendar for you, so let's kick things off with our economic calendar. Now you notice right away it's actually very, very busy pretty much every day of the week, but there's two announcements I want you to focus on, and they're both on Wednesday, so Wednesday is pretty much your busy day. First one's that Bank of England down there. You can see they're staying at 0.5%, so really no change there. That shouldn't be a major market mover. What will be a major market mover also happens on Wednesday for the United States, and you see our rate statement. Right now we're at 1.5%. All expectations right now, about 90% probability on the CME, are looking at raising it 25 basis points to 1.75. Now, why is this important? Because the Fed has historically used interest rates to slow down the economy or to speed it up using that policy number. So let's look back historically and see how this stacks up to historical charts. Here we have all the way back to 1997, the S&P 500, and you can see on that hard left edge we had a significant rally. And all of a sudden, boom, 2000 to 2002, we had a significant sell-off of 50%. So half of your gains evaporated, gone. Well, all of a sudden we had a rate cuts, and we'll look at those here in just a second. But we saw that market rally 104% right there. Boom, jumps another 104%, followed conveniently by another 57% sell-off. So half your gains, boom, gone right there as well. Now we're in the midst of this monstrosity of a rally of 314%. So what has the Fed been doing to slow down this rally? Because clearly they should be trying to slow this down, right? Well, the good news is our crack team of investigators have put all the rate announcements from 1997 through till today, and you can see these little mountain charts have just formed on your chart. Why is this important? Because back from 1997 to 2000, they raised rates to slow down that running market, and they also lowered rates significantly to help that fall. Same thing, from 2004 to 2006, they raised 17 times that interest rate policy to slow down that runaway market. Remember, it only moved 104%, but that was runaway at that time. All of a sudden, we have this 57% decline where they dropped rates all the way down to zero. What's unique about this picture is see how long it stayed at zero? From 2009 to 2015, it went nowhere. It just stayed flatline. That's not normal. That is kind of peculiar and actually should be kind of frightening going forward because they've done nothing to slow this down, which means what will come to an end could come to an end much faster, much sharper, and much more aggressive. Now, where would that 1.75% interest rate put us? Nice little red line here shows us. You can see it's really not that important yet. We'll talk about the FOMC statement a little bit later on, but it's really what they say about this rate number going forward that's the key issue. Let's move on to our earnings calendar, and you can see we've got some pretty big earnings names out here. We've got Microsoft, we've got Alphabet, and of course, Apple. That's the one I want to focus on right here. Now, Apple is important to us because it's one of those stocks that everybody says you just buy it before earnings, you're going to make a bunch of money. Really? Let's look at some charts. Here you have your chart going all the way back into 2016. Here's an earnings announcement. They beat and had a nice pop up. Here they also beat. Oh, wait, they didn't go up like they're supposed to. Yeah, everything works until it doesn't, folks. Here's another one. We had a nice big earnings beat and it rallied up. So let's look at their expected earnings announcement for Wednesday and see where we stack up. You can see going all the way back into Q4 of 2016, they beat pretty much every quarter. Well, right now you're looking at $3.75 expectations for Q4 2017, and that is a 100% increase over Q3, $1.84 to $3.75. Personally, I think that that's a little bit lofty, and if you look at that chart of Apple, you'll see that for 2 months, it's pretty much gone sideways. If it was really going to beat earnings, you'd probably have more upside trajectory. We don't, so be careful with that Apple earnings. Personally, I would just walk away from it and leave it alone. All right, let's look at some of our news out there. We've got a record low VIX. Now, why is this important to you? Because VIX is a fear gauge. You want to know when people are afraid, when they're panicking, or when they're overly euphoric about something. Well, let's take a look at this chart so you can get an idea of what this means to us as investors. Here you can see that VIX chart. It's stuck. Actually, we hit lows of 8, which is really significant because historically, it's supposed to be between 20 and 40. They say if it drops below 20, which is that lower line there, that's a time where you should be looking to buy, and when it's above 40, you should be looking to potentially sell. Well, if that's the case, you'd be looking to sell since 2010. Really? You'd be losing a lot of money if you were selling at that point in time. So we want to keep an eye on this one because we are expecting there to be some spikes here. It's been too complacent for too long, and it could be any piece of news or economic announcement which spikes this, but a big spike in that VIX could cause that S&P and our overall equity markets to start to dive down, which means you could lock in profits or potentially make money in a down market. All right, let's look at some major news headlines out there as well. Like we looked at the VIX, let's look at OPEC. Why is it important? Because OPEC is always jawing back and forth how they're going to do this, do that. Right now they're talking about cutting back on supply, production, really lowering the production amounts out of the ground. Well, that could have an impact on crude oil prices. So this could create an opportunity. How do we know? Well, let's go look at our OTA Mastermind supply grid. Here you can see the supply grid of a bunch of different asset classes. We're going to focus on this USO crude oil here, which between 1595 and 1650, we've identified a nice supply zone, which may be an opportunity for us to go short. Now, we also have some opportunities here to go long, but right now we'll look at the supply zone, not the demand zone, for a shorting opportunity. Now here you can see that chart of USO going all the way back into 2015. That's what that little yellow box is, identifying that supply zone. If we carry that forward, you can see we've got quite a ways to go from current price of about $12.50. But if OPEC does cut, you could see significant spikes, which would bring in a lot of new investor money. A lot of times that euphoria drives things right up to an overhead supply zone, which we've identified here between $15.95 and $16.50. That could create a selling opportunity for you to lock in profits or potentially even open a short position. Last part of our news here is going to be the FOMC meeting. Now remember, on Wednesday, they're going to raise it 25 basis points. Almost a foregone conclusion. But what is important is what they say after that announcement. What's their stance going forward? How many more interest rates do they expect in 2018? That will all be disclosed, or at least give us some hints about what that information may be. So I encourage you guys to follow that one. Of course, you can tune in next week as we give you more information on the Online Trading Academy Quick Look about all these pertinent financial matters.